Good afternoon, all. This is John D'Agostino of the Connecticut Green Bank and Inclusive Prosperity Capital, and welcome to our webinar this afternoon on solar financing for affordable multifamily properties. I'm joined today by Louise Venables from our finance team, who will be supporting our presentation as we walk through the Green Bank's solar financing offerings. A couple housekeeping items. If anyone has questions throughout the presentation, feel free to log those into the private chat, or I guess the public chat window, and we'll try to catch those during pauses in between slides or roll them up at the end, whatever is kind of convenient for the flow. So I guess we'll just go ahead and dive in, and I look forward to seeing what questions you have at the end. So again, presenters today, John D'Agostino. I support the multifamily program at the Connecticut Green Bank. Louise manages multiple solar offerings on the finance side of the house, on the front end and on the back end. So we try to work very closely in concert to be proactive, but also to triage issues and move projects along through the PPA process. And I'll speak more about the loan processes that I manage as we get into the presentation. So just for background, I presume most folks on the line are already familiar with the Connecticut Green Bank, but a very high-level overview for those who are not. The Connecticut Green Bank is the first green bank in the United States. It was incepted as the repurposed Connecticut Clean Energy Fund in 2011. And the mission and goals of the Green Bank is to support the governor and legislature's comprehensive energy strategy to achieve cheaper, cleaner, and more reliable sources of energy while creating jobs and supporting local economic development. So some of the sub-goals here, rather than simply providing funding via grants, as the Connecticut Clean Energy Fund did, the purpose of the Green Bank was to take our income, our funding that would come in, repurpose it as through various structures, credit enhancements, loan loss reserves, et cetera, in order to facilitate private capital being deployed into the market that was sitting on the sidelines due to a lack of familiarity with renewable energy and energy efficiency as an investment class. So that's kind of goal number one. In that same vein, the goal is to leverage those limited public funds. So typically, rather than putting those funds to work directly, we put the funds to work indirectly and try to achieve a 6-to-1, 7-to-1, 10+to-1 ratio of private capital deployed for every public dollar that's at risk. We're also tasked with developing and implementing strategies that bring down the cost of clean energy in order to make it more accessible and affordable for consumers. Depending on the division of the Green Bank, these programs look a little bit different because we're trying to fill gaps in the market where traditional financing is not already participating. So I like to liken the Green Bank to a little bit of a Swiss Army knife, various tools for various needs. So we'll be speaking today just about the financing offerings through the affordable multifamily space. But if you have projects in the commercial industrial space, the single family residential space, or the statutory and infrastructure, we're always happy to hand you off to the right people internally to work through those projects. And finally, and the main purpose of our conversation today is to support affordable and healthy buildings in the low to moderate income space by reducing their energy burden and addressing health and safety issues. Our focus will be primarily on energy, but the presentation today will not cover all of the Green Bank's products, but just as context, we additionally have pre-development loan programs that allow folks who either don't have the funds to do the pre-development work that they need to do in order to get their project into kind of the right position, or with the right set of analyses, and understand what scope of work should I implement, but also for folks who don't know where to get started, and to give them an opportunity to figure out what their project is and to proceed with that project. On the health and safety front, the Green Bank also supports the Energize CT Health and Safety Revolving Loan Fund, which is a loan fund specifically for health and safety remediation of projects that are going to be pursuing an energy, a renewable energy or energy efficiency scope of work. So if you have any interest or questions about that program, feel free to contact me offline, and I'm happy to plug you in with the appropriate resources. So at a high level, just looking at how we define multifamily and affordable. So for our purposes, multifamily is 5+ units. We recognize that there is a multifamily market in the 2 to 4 unit space. If it's an owner-occupied building, that falls under the rubric of our single-family program. If it's investor-owned 2 to 4, we currently don't have a program offering in that space, but it's on our horizon for product development. So anything we'll be discussing today is constrained to the 5+ unit arena. We serve both the income eligible and the market rate segments: private nonprofit owners, public housing authorities, senior assisted living, condominiums, and co-ops. And in terms of affordability, we're seeking, the market segment is defined as at least 60% of the units must be at 80% of area median income or below. We also have other metrics by which to define affordability, including HUD qualified tracts, and also naturally occurring affordable rents, et cetera. So the AMI designation is not the only mechanism by which we can define affordability, but it's the primary one by which most properties kind of come in and are qualified. So digging in, solar at a very high level for those of you who are less familiar or maybe not familiar at all. So solar PV systems in Connecticut utilize a program called net metering. The basic premise here is you have buildings that they're currently purchasing electricity from the grid with a system that is installed on the roof of a given property, or maybe it's a ground mount system within the property limits. That system is going to produce electricity, and when the amount of electricity it produces exceeds the amount of demand at the property, that electricity is going to be produced onto the grid. At times when the system is not producing as much demand, so in the evenings perhaps, or in periods of low insolation in the winter, then electricity is going to be purchased from the grid. So net metering basically is a billing mechanism that allows that input-output to be quantified and banked. And so that production on this PV system can be credited on an annual basis. So typically with PV systems, there's an annual true-up in order to determine how much was the system expected to produce and how much did it actually produce, and then making sure that credit is paid out in either direction to make sure that there's a balance. There's no balance at the end of each year. And the major distinction here is that the wholesale rate is generally much lower than the retail electricity tariff. So systems that are producing on top of properties' roofs are being credited at the retail rate. So there's compensation for the property owner. So this is just one example from several years back. This is one of the earlier solar power purchase agreements that the Green Bank did. This is from 2015. I save it just because it's a nice interpretive graphic. So this is the Ashford Senior Housing Center in Ashford, Connecticut. This was installed, I believe, in early 2015. You can see on the right-hand side, this is the estimated versus actual solar power generation. In the orange, you can see that the estimate, this is kind of a straight line estimate of how much power is going to be produced during the year. Which isn't necessarily the case, of course, right? We're going to have more sun during the summer and less during the winter. So you can see the actual generation on a month-by-month basis, and this is across 9 months in 2015. The point here is that even though in some months there's less generation than the straight line projection, in other months there's more. And at the end of the day, the estimated generation was about 80,462 kilowatt hours, and the actual generation was slightly more than that. Any PV system is going to be sized based on the existing electricity usage. So we seek at least 6 months, preferably 12 months of electricity demand data as part of our loan and PPA process in order to kind of ground truth the appropriateness of a PV system size. So because this is from 2015, of course, it's helpful to have an update. So I pulled the data from 2018 for the same property. This is 12-month data, and the projected production in 2018 was a little over 86,000 kilowatt hours, and the actual production was about 96,000 kilowatt hours. So the key takeaway here is that systems, the projected production of a given system is based on long-term geographic averages for insolation. So there are certainly folks who, they have a system installed, and in a given month, it may be particularly cloudy or it may be particularly sunny, and a system may under or overproduce based on expectations. But the key takeaway here is to understand that those projections that are being provided are ground truth in long-term insolation data. So in the long run, the number should even out. That being said, there are, so again, there's a true-up process as part of our financing as part of net metering. So so the larger point being is to take the long-term perspective and understand that systems are being monitored throughout the state for underproduction, for aberrations from what other systems in a given geography are seeing. So incentives. At the very highest level, the two major incentives that are furnished to commercial projects in Connecticut, this is federal investment tax credit for PV owners. That's a credit of 30% of the qualified system costs. It's non-transferable and subject to a 5-year recapture if the ITC is sold or decommissioned. And there's also accelerated depreciation over a 5-year period. So there's a tax benefit, in short, over a 5-year period. So if you are a for-profit property owner with a federal tax liability, then that tax credit is to your benefit. If you are a not-for-profit and therefore you don't have a federal tax liability, then that value is not, utilizable at the most basic level. There are folks who, can take the benefit of that tax credit and shop it to someone else, but there's a lot of legal fees involved in doing so, and the structuring is kind of complex. And I'll get into this in a little bit, what the Green Bank has done is developed a solar power purchase agreement fund where we partner with an existing tax equity provider in order to monetize the value of that tax credit and pass along that benefit to not-for-profit and public housing authority property owners, so that that value is used and not forsaken as part of the transaction. The other incentive is the state-level renewable energy credits, or RECs. For most projects, these will be in the small ZREC arena, as you see below, which is smaller than 100 kilowatts. There's also the medium ZREC and the large ZREC pool. And ZRECs are contracts of payment based on production for a given system over a 15-year period. So for every 1 megawatt hour that's produced, there's 1 ZREC that's produced, and depending on the demand for those ZRECs, the pricing varies by the year of issue, and it also varies by electric service territory. So those of you who are in United Illuminating Service territory, the ZREC price will vary against those of you in Eversource territory. So these are the incentives that would go into a given project. In areas where ZRECs aren't available, then those would not be on the table clearly. And in cases where there's not a federal tax liability, the ITC would not be available. But the larger point being that both of these contribute towards decreasing the overall net system cost of a given multifamily PV installation. So digging into the Green Bank solar financing programs, there's three major financing vehicles that the Green Bank supports. The first, as I've already mentioned, is our solar power purchase agreement. So this is for solar projects only. It's basically an off-balance sheet solution, so it's similar to switching your electricity, generation supplier. Rather than switching your supplier, you are having a system sized onto your property, given your existing electricity demand, and you're entering into an agreement to purchase electricity from that system for a 20-year period. The terms for these are 20 years. There are also 5-year additions that are a part of the PPA structure, so you can extend it to 25 years or to 30 years. There's also a buyout option. There's a purchase option at the end of year 5 and every year thereafter if you're a property owner who wants to, not own the system and make sure the federal ITC is monetized and that value is passed along, and then you purchase a system at a depreciated value down the road. That's of interest to many folks. We have fixed or escalating options for that solar PPA. The vast majority of folks in the Connecticut market choose fixed options because it locks in their pricing for the next 20 years. We're not going to do any projects unless there's a minimum 10% energy savings. So if you're paying 20 cents a kilowatt hour in variable pricing, so you have to add up all of your per kilowatt hour line items on your electric bill. If we can't price a solar PV system at least 18 cents a kilowatt hour, there aren't sufficient savings to kind of move forward with that system. We want to make sure that we're saving the end user money. And a given system, this goes for any system. A lot of folks ask, well, what kind of pricing can I anticipate? And that's going to be site dependent, right? So if you have a south-facing property, it's a roof without a lot of HVAC or other kind of instruments or things impeding a solar PV install, then that pricing is going to be a little bit more ripe and attractive based on the production that system can produce. Then a similar system that's maybe shaded or it's north or kind of northeast, northwest facing. So it's very site dependent. The pricing that can be offered is dependent on how well the system produces. The best way to get started with any solar PV system, using our financing or not, of course, I like to liken it to a home improvement. Call 2 to 3 vendors, make sure to get a quote from them so that you can have a sense of a comparison of price and equipment in the market. So that's solar PPA at a high level. The following two products, Lime and CPACE, these are both effectively they're loans. Lime stands for Low Income Multifamily Energy, and this is a loan product provided by our partner Capital for Change. So it's provided in partnership with Capital for Change. And this is an unsecured term loan for affordable multifamily properties that, in the same way we mentioned before, how those affordable multifamily properties are defined, runs from 5 to 20-year terms. Interest rates currently run from about 6 to 7%. And in the same way that solar PPA is looking for at least a 10% savings on your variable electricity price, the Lime loan is underwritten based on an energy savings coverage ratio. So we want to make sure that the cost of the system, when you're servicing the debt on your loan, you're saving at least 10% more over the life of the loan than you're paying in debt service. So it's described as a 1.1 energy savings coverage ratio. I mentioned the Lime is unsecured, so the only security is a UCC1 filing. For new construction projects, Lime may seek a mortgage on the property. And recently, the Lime program has actually been expanded to market rate properties as well. So I'm happy to put you in touch with the folks at Capital for Change if that's a product of interest as well. Finally, CPACE. So CPACE is typically our market rate tool for solar in Connecticut. It's a secured financing mechanism, so it's secured by a first position benefit assessment on a given property, and then the loan is paid back on property taxes. So there's not a separate billing for a CPACE loan or benefit assessment. All the capital is provided up front for a given project. And then again, we're looking for an energy savings coverage ratio 1.0 or greater, such that, the solar installation is going to save you at least as much as the debt service that's going to be repaid over the life of that loan. CPACE term runs from 5 to 25 years. Interest rate's a little bit lower because it's a secured financing mechanism. And the other thing to flag here is, while the solar PPA is solar specific, Lime and CPACE are not solar specific. They're technology agnostic. So, we tend to see a lot of Lime and CPACE projects that are efficiency and solar. Both Lime and CPACE can also support ancillary measures or work that needs to be completed as part of a given project. So we have some projects that have financed roof replacements, so long as the energy savings coverage ratio supports that scope of work and its expense. So digging into the solar PPA, again, it's a contract between the seller, in that case it's the Connecticut Green Bank. It's specifically a fund that the Green Bank has set up, and the buyer, who is the lessee of the system, on whose property the PV system is being installed. The Green Bank is the seller. We oversee the development, the construction, and the asset management, and the buyer is responsible for purchasing the electricity from the solar that's installed on that property. So the benefits of the PPA: there's no upfront costs for the system installed. There may be some costs that are needed in order to kind of prepare the property for the solar install. Those costs, again, as they're related to the solar PV system, can be financed through the PPA structure, so long as they're identified ahead of time and incorporated into the pricing. You're locking in a discounted electricity rate for the life of the PPA term. As I mentioned earlier, the overwhelming majority of PPAs that the Connecticut Green Bank, that I've seen, I don't want to speak for the entire team, have been fixed, because it allows folks to lock in a given price, and it allows price confirmation and predictability. You're positive cash flow from day one, because as I mentioned, we're not going to do a PPA unless there's at least 10% savings on your variable electric bill. The Green Bank is responsible for operations and maintenance costs of the system. There's actually so insurance and what have you, warranty is kind of baked into our pricing model, is baked into the fund that we created in order to provide this offering. It saves capital reserves for a lot of properties that don't, have kind of the reserves or the cash available to own a system, or to have kind of side payments for operations of a solar PV system. And it monetizes the value of that federal ITC. So for those properties that are not for profit or don't have a federal tax liability that seek to own a PV system, they're effectively paying a 30% premium on a given system in the absence of being able to utilize that federal ITC. So this is just kind of a representative example of how the discounting works, and this might be a little bit of an extreme example. On the left, you see a given utility bill. That utility bill is comprised both of fixed charges but also variable charges. So let's just say that it's $10 a month. On the right-hand side, you can see both the savings at the top, and beneath the savings, there's the PPA cost. So there's a bill coming for the PPA based on the production of a given system. And then there's a resulting bill, right? So there's some savings via the PPA structure on a given electric rate. So if you're paying 20 cents a kilowatt hour, and then your PPA is priced at 15 cents a kilowatt hour, There's that delta, and you multiply that by the number of kilowatt hours that you're producing in a given month, and that's your savings amount. And then your resulting in blue is the 15 cents a kilowatt hour times the number of kilowatt hours your system produced that month. And then below that is still the remaining utility bill, and that sizing is going to vary a little bit by, again, time of year. Was it unusually sunny? Are you in the winter? And there's still going to be fixed charges. It's not as though you are disconnected from the grid. You're still paying for the grid services and interconnection. But your overall cost to purchase electricity is decreased by some savings amount. That's the key takeaway. Digging a little bit deeper on the Lime and the C-PACE products. On the Lime loan front, this is Willington Woods. This is a project that was installed by Access Willington, which is a subsidiary of the Willington Housing Authority. This is a 40.3 kilowatt solar PV system. The project cost was approximately $170,000. The loan that was taken out was about half of that. It was a 10-year loan at 6.5% interest, and the estimated 2018 return on investment was a little over 10%, which is short of 11%. So, depending on the magnitude of a given electric bill, it's not earth-shattering, but it's substantial, right? There's real savings to be had there, such that the payback on this system, given that loan, is a little over 9 years. On the C-PACE front, unfortunately, we actually don't have a multifamily solar project that has used C-PACE to date. So I'm using a C-PACE solar project that was done. This is a commercial industrial project that was performed at Crest Mechanical in Hartford. You can see total project cost, $145,000. C-PACE provided the entirety of those funds up front for a 55 kilowatt roof-mounted solar PV system. There's a 20-year term. The annual C-PACE benefit assessment was about $11,900, and the annual cost savings was a little under $21,000. So, in year one, that's a $10,000 savings. So over the lifetime of that PV system, the expected savings are about $417,000. So quick product comparison. Going across the board, solar PPA on your left, Lime loan, and then C-PACE. So solar PPA I mentioned, it's an off-balance sheet solution. It's basically a contract to purchase electricity. There's no upfront cost. The Green Bank owns the system. They maintain the system. They're responsible for any system issues. Ancillary project work can be financed if it's identified prior to the execution of the PPA, and that would be incorporated into the pricing. And then the benefit of the federal ITC is monetized and passed along to the property owner. Part of that benefit is, of course, taken by the investors in our solar PPA fund, but some of that benefit is passed along, to the benefit of the property owner as part of the overall pricing structure. Lime loan, I mentioned, unsecured UCC1 filing on the equipment as part of the loan. In the same manner, ancillary project-related work can be financed so long as it's identified prior to the loan document execution, ideally it's part of the loan documents, and it's also subject to the energy savings coverage ratio. So for solar projects, excuse my cough, if you have a 1.1 energy savings coverage ratio, but your solar PV system actually comes in at 1.4, 1.5, and there's some ancillary related costs. Maybe it's a roof replacement or some other scope of work. It's tree removal and the like. That can be included in the financing so long as the energy savings coverage ratio still exceeds that 1.1 threshold. The federal ITC is monetized by the property owner, independent of the loan. So the ITC, the onus there is on the property owner for them to claim that as part of their federal tax filing. And then finally, C-PACE. The C-PACE loan, it's a secured loan. It's secured to the property in a first position, on the property records. So in order for that to proceed, we have to obtain lender consent. Part of the reason we do not see as much CPACE, or we haven't seen any CPACE solar projects in Connecticut to date, is the challenge in terms of obtaining lender consent on subsidized properties. So if there's HUD mortgages or FHA insurance, or if Freddie or Fannie Mac, typically there are terms and covenants that are prohibitive to other financing being in a first position, or displacing, their financing from the first position. So that's actually the reason why we developed the Lime Loan product, was to provide an unsecured product that, kind of walks and talks like CPACE, but can be utilized on subsidized projects. In the same manner as PPA and Lime, for CPACE, ancillary project work can be identified, so long as it's identified ahead of time and incorporated into the overall work scope. And again, the federal ITC is monetized by the owner, independent of the loan. So overall program to date, kind of how much work have we done so far? We've done 30 solar projects, and that's closed. We have at least another 10 or more in the pipeline at various stages. 19 of those have been power purchase agreements. The overwhelming majority of those power purchase agreements have been done in partnership with the Connecticut Housing Finance Authority. We've done 2 rounds of Solarize SSHP, which was, an offer to state-sponsored housing portfolio properties to pursue a solar PPA with the Green Bank. Some of those were ground mounts, as you see in the bottom left. A lot of them were roof-mounted properties, actually the bottom left and the bottom right, and others were roof-mounted properties. 11 of the solar projects to date have been Lime loans, so folks that had a benefit for the federal investment tax credit, or were able to make the economics work in the absence of that federal investment tax credit, and it was worth their time to take out the loan to do so. The average system size is just short of 100 kilowatts, and the average number of units for a given property is 70. So as I will show on the next page, so in order to move forward with a solar PPA, and this is kind of a time value of money threshold, we need system sizes that are at least 30 kilowatts or larger. So based on the ratios from the previous page, where a 100 kilowatt system is about 70 units, a 30 kilowatt system is approximately 22 units, something like that. Presuming, and this is bullet point number 2, that the electricity is master metered for that property. So the low-hanging fruit in Connecticut are properties that are master metered for electricity. Conversely, the other opportunity is when there's a large common area that is paid by the property owner, whether it's a housing authority or otherwise, that needs to be offset. Typically in older converted buildings, schools and the like, that become senior housing, there's a large common load, so that's an opportunity where solar might be a good fit. It is possible for projects to sub-meter electricity in Connecticut, but in order to do so, there has to be a docket that's filed with the Public Utility Regulatory Authority, and that's an involved process. So what we have found to date is that properties that have at least 150 units, I don't want to speak for the property owners because I haven't myself been through the process, but having spoken with those who have and watched from the outside, properties where it's 150 units or more, the juice is kind of worth the squeeze to figure out the sub-metering and how that looks, and kind of prepare all the documentation and work through the pure approval process. Smaller than that, master meter properties are the best opportunity for the solar PPA, for sure. Programmatically, all multifamily solar PPA projects moving forward are going to be required to have snow guards installed above property entryways, as part of the standard terms of the PPAs. We've identified, and it's been brought to our attention, that a number of installs that were installed without snow guards, some of the installs were performed above entryways, and based on how this last winter was, we'd have 3 to 4 inches of snow, and the next day would be 55 degrees, and the snow would kind of slop off the roof and right where folks had shoveled out entranceways. So to mitigate against that, we're going to make sure that the snow guards are part of the standard offer moving forward. The Green Bank is also developing a snow guard solution for existing solar PPA lessees. That shouldn't be a second bullet point there. So we'll be rolling that offer out to folks to make sure that snow guards can be installed for properties where there's a need to do so for existing PPAs. Procedurally, PPA projects tend to have long development timelines. They're frequently 8 months or more. This is due to a combination of factors. There's complexity involved with the PPA process because there's one contract agreement between the Green Bank and the site lessee of the PV system, and then there's another contract between the Green Bank and the installer, because at the end of the day, the installer is developing the project for ownership by the Green Bank, and then the Green Bank is selling the electricity to the property owner. So those projects that typically move most quickly have an internal champion, someone who's really kind of pushing and responding. It's not a problem to move things, at our best opportunity, but as turnarounds of documents or questions kind of go unanswered or unfacilitated for a week, a week here, a week there, and time starts to add up. So those folks who are significantly motivated will help the Green Bank team in terms of moving projects along at an accelerated rate. Any equipment and installers that install a solar PPA with the Green Bank have to be vetted by the Green Bank for both technical and financial faculty. So there's currently 23 eligible installers. You can contact myself or Louise in order to obtain a copy of that list. This is not to say that an installer who isn't currently eligible can't become eligible. We're an open market quasi-government agency, and so the goal here is just to make sure that we have an understanding of, this installer has experience in the commercial arena, they are financially stable, we can anticipate them being financially stable into the future, and the same thing goes for the equipment that's being installed. We want to make sure that panel manufacturers and racking manufacturers and inverter manufacturers, are going to be in business, that their products aren't going to break down, or fail over the life of the PPA. So all of that is due diligence internal at the Green Bank to make sure that the system that's being installed is the best system for your property. And I mentioned earlier, in order to get started, I recommend folks like any home improvement to get 2 to 3 project vendor quotes. This helps you, one, familiarize yourself with the solar PV equipment and the installation process, but it also helps you just kind of learn more about the installer. We always want folks to have a positive experience with their installer. We don't want it to be installer that they found one installer and they just moved forward because they didn't take the time to really get to know the installer and their experience and their professionalism. So that's always helpful, and it helps you kind of have a positive experience throughout the solar installation process. And that's actually, so I went through the entire thing, and Louise, I presume you're on. I hope that you're unmuted, and if there's anything I missed and you want to call me out for, I strongly encourage you, feel free to chime in right now. I'm sure there's plenty, because I went fast and slow there.
Can you all hear me? Have I been unmuted?
Yep.
Oh, great. Of course, it would only be you that responded to that, John, because everyone else is muted, like I was before. That was fantastic, John. I don't think I would add anything, any more details to what the program looks like. very happy to answer questions about the experience of having solar as a multifamily property. We've had a couple of systems that have been installed for a number of years now. And so we've worked through what it looks like a couple of years in to having one of these PPA solar projects at your property. So if anyone has any specific questions about that, I'll be on hand to answer.
Great. Thanks, Louise. So we do have one question that's come in, and the question is whether PPA savings over utility prices work similarly for individual residential customers. So I presume this is single-family residential when vendors offer a PPA for home solar. So it's a little bit outside the purview of this presentation. The basic premise is the same, right? If someone is offering you a product, ideally it's to your benefit if that product saves you money, unless there's some value add where there's a green halo effect for you going solar. So for the green bank's offerings, we're not going to provide a PPA unless it saves you money. We're not going to approve a CPACE or a Lime loan unless the savings outweigh the expense. That being said, for single-family residential, I don't want to speak for the entirety of the market, but there are plenty of providers out there who, either the pricing is high, in which case it shouldn't necessarily grab your attention. In other cases, and this may be more so the case, there's an escalator, right? So maybe there's a year one savings, but in subsequent years, the PPA or the lease is escalating by some percentage such that in a handful of years, you're actually paying more than you were paying currently through your utility. So, buyer beware, caveat emptor. You want to make sure that you're reading the fine print and understanding exactly what pricing you're being provided both in year one, but how that pricing is going to change over the life of any agreement. Other questions that folks have? So we have a question about PPAs, including ancillary work. So an example of that ancillary work, and then that cost is integrated into the kilowatt hour of solar. So the short answer is, it has to be germane to the work. So in instances where we have carports, right, the installation work is not merely the solar PV system. It's the cost that goes into developing the structure on which the carport on which the solar PV is installed. So if that's the scope of work, that cost will be included into the PPA structure because it's part of the total cost of doing business in order to provide the installation. Louise, is there anything else you want to add on that point about ancillary work being financed through the PPA structure? I want to make sure I'm capturing that correctly.
There's a limit to the value of the ancillary work as it relates to the overall value of the project, and it's not a kind of hard and fast rule as to what that limit is. We look at things on a project by project basis. So if there's an ancillary kind of amount of work that's required, we would have to see the quote for what that would be, for example, a roofing upgrade, and then compare it to the overall project cost of the roofing upgrade plus the solar installation, and take a view on whether we could use the PPA as a way to finance both the installation and that ancillary work. So long answer, but we do look at it on a case-by-case basis.
No, that's super helpful. Yeah, it's not just carte blanche, right? It's we want to consider it in the context of the system that's being installed and financed. Yeah, that's great. Any additional questions? Going once, going twice. Okay, I think that's all we have for today then. So folks, if you do have questions, My email, my phone contact is here. Louise, I neglected to include your phone number, which maybe is for the best. But, please feel free to reach out with questions. Anything from I'm interested, tell me about the process, to, can you provide, some referrals of folks in my area who have done a solar PPA. I'm happy to make those introductions. So with that, we'll give you guys back the last 10 minutes of the hour, and thank you for joining us today, and look forward to hearing from you down the road.